So what if I told you there's an investment strategy that has been academically proven to beat the market for over 200 years, but almost no one has the stomach to actually use it? Today, we're breaking down momentum investing. It's finance's most persistent and, honestly, most powerful puzzle.
Okay, so let's just dive right in with the big question that frames this entire explainer. This is the paradox we're going to solve over the next few minutes. And let me tell you, the answer is fascinating, and it has a lot more to do with human psychology than it does with spreadsheets.
All right, first things first. Just how significant is this strategy? Well, it earns a very special nickname from a very, very unexpected source. That's right. Eugene Fama, the Nobel Prize winner who basically built his career on the idea that you can't consistently beat the market, he's the one who admitted that momentum is the biggest glaring exception to his own rule. I mean, that's like the world's most famous skeptic admitting they've seen a ghost. It just tells you how robust and undeniable the evidence really is. Now, to really get what momentum is all about, the easiest way is to put it side by side with the investment style that most people know, which is basically its philosophical opposite, value investing. So what's wild about this is that these two incredibly successful strategies are fueled by the exact opposite human mistakes. Value investing works because we panic and we oversell on bad news. Momentum works because we're too slow to believe good news, causing prices to kind of drift up gradually instead of jumping all at once. They're literally two sides of the same behavioral coin. So how does this actually play out in the real world? Well, the engine behind momentum isn't some secret formula. It's just a predictable set of flaws in our own psychology. So here's the deal. Momentum keeps working because we as investors are just predictably irrational. We anchor to old prices, we feel that itch to sell our winners way too soon, and then we absolutely cannot resist chasing a hot stock because of that fear of missing out. And this table just breaks it down perfectly. Each one of our little mental glitches creates an opportunity. Our initial underreaction gets the trend started. Then our tendency to sell winners too soon actually keeps the trend from getting too hot too fast, making it last longer. And finally, that herd behavior, that FOMO, gives it that last big push. It's a whole cycle, and it's driven entirely by human nature. This quote it nails it, doesn't it? It perfectly captures the whole idea. The reason powerful strategies like momentum keep on working is because of us. The weak link isn't the theory. It's our own difficulty in just sticking to the plan, especially when things get choppy. Okay, but here's a super important detail for anyone thinking about this stuff. Not all momentum is created equal. You can't just buy any stock that's gone up recently. The real secret is finding the trends that are smooth, steady, and kind of flying under the radar. To really get this, academics came up with this brilliant analogy called the frog in the pan effect. You know the story, if you drop a frog in boiling water, it jumps right out. But if you put it in cool water and heat it up really slowly, it doesn't even notice the gradual change until it's too late. Well, stocks are kind of the same. A huge overnight price jump gets everyone's attention, but a slow, quiet, steady climb, that often goes completely unnoticed. This really shows you why a stock that grinds up 100% nice and slow over a year is a way better momentum candidate than one that jumps 100% overnight because of some big news. That smooth momentum is where the underreaction is greatest, and that's where the real sustainable edge is. So to actually find these frog-in-the-pan stocks, practitioners use a very specific formula. They'll look at the last 12 months of performance, but, and this is the key part, they throw out the most recent month. It's a really clever way to sidestep all that noisy short-term reversal stuff and focus on the more stable, intermediate-term trend. So far, momentum sounds pretty great, right? Almost too good to be true. Well, now we get to the most important part of this whole explainer, the reason it's called an anomaly and not free money. We have to talk about the crash. And here's the big twist. The greatest danger to a momentum strategy isn't a market crash. It's the sharp, V-shaped recovery that comes after it. In those moments, all the most beaten down, junky stocks, last year's losers, they rebound the hardest. And the high-flying winners that are in a momentum portfolio, they get absolutely crushed. And look, this is not a theoretical risk. Look at this number. This was the actual loss for a long-short momentum strategy in just 3 months during the 2009 market rebound, while the rest of the market was soaring. It's a brutal, violent, portfolio-destroying kind of event. And that, right there, is the answer to the question we asked at the very beginning. This is why everyone doesn't just do this.
No professional money manager on earth can survive telling their clients they lost a ton of money while the market was roaring back. They'd be fired instantly. This intense psychological pain, this career risk, is the barrier to entry that keeps the momentum anomaly from being competed away.
So, with these incredible rewards and these absolutely terrifying risks, how can a thoughtful investor even approach this thing? Is there a way to harness the good without being completely destroyed by the bad? Well, the research points to a surprisingly elegant solution. Instead of choosing between the yin of value and the yang of momentum, you combine them. But the trick is, you have to keep them in separate, pure portfolios and then combine those rather than trying to find some magical stock that's both cheap and trending at the same time. And this is where the magic happens. Because these two strategies often do well at completely different times, they basically act as a natural hedge against each other. When value is struggling, momentum's often flying. And when momentum inevitably crashes during a market recovery, that's usually when value stocks are leading the charge. This combination can dramatically smooth out the performance ride, which makes it psychologically so much easier to stay in the game. And that's really where this leaves us. In the end, the secret to momentum, and frankly, to all successful investing, isn't about finding the perfect algorithm. It's about finding a process you understand, that you believe in, and that you have the discipline to stick with through thick and thin. The real puzzle isn't in the market, it's in the mirror. So the final question is, what process will you choose? And can you really stick with it?